Dave Valcourt, welcome to the show, man.
Appreciate it.
So there's a lot of things that we could talk about. I think we're going to nerd around premium finance and this thing called private placement life insurance. There's been people that have talked about it. I think the ultra wealthy use it. What I love about you is you guys work with very wealthy individuals.
Absolutely.
And you're saying like your average person that you're working with is like worth $300 million. And so all in all, I'm here to learn. I know that there's a lot that we can dive into. Would love to get your story, but then I would really love for people watching this or listening to this to have like a true masterclass on premium finance, private placement. I'm sure we might also go to other places, but I know that you weren't just born out of the womb like, hey, I'm going to work with ultra high net worth people and use life insurance strategy. So how in the world did you get in this space?
Yeah, thanks. And thanks for having me. So my path to life insurance is, I think, pretty non-traditional. I grew up on a farm in New Hampshire, and my parents were very middle class. We didn't have life insurance. I always thought of it as something that was used for burial costs, really. And so when I was finishing up school, I was working at Fidelity, trying to figure out what I was going to do, and ended up replying to some Craigslist ads. Okay. One of them happened to be a recruiter who had a line for, who had a job opening for the company I work for, Financial Architects Partners. And then when they described to me what they did, I was like, I didn't know that this existed. Yeah. And so I was very intrigued. Yesterday was my 17-year anniversary working there.
Wow, congrats.
And what was interesting about the space for me is not only are you solving problems, but the creativity that you can have around how you solve those problems and how you incorporate life insurance into a solution was something I guess I never really considered. And a lot of people think that working with wealthy people is all about them making money. But what drew me to this is the fact that a lot of people who build really cool things, companies, products, ideas, they put a lot of their time and a lot of their money back into making it better. Yeah. And so if they want to leave that to their kids and all of their wealth is tied up in the company, when they die, the government's going to want 40% of it. And so how do you make sure that these businesses, these ideas, this life work makes it down to where the family wants it to go, to the kids or to charity? And that's really what drew me to wanting to kind of explore this and get deeper into it.
The average client that works with you, what would you say their number one pain point is? Is it to keep as much money after they pass away and keep their legacy going? Or what would you say, like if you had to say like, this is like the top thing or the top two things that we solve when it comes to
So it started out a lot of estate tax planning and making sure that there was liquidity. And I had a partner who used to always say, why pay $1 of estate tax with $1? Yeah. These products exist for a reason. Yeah. And if you can pay with, 25 or 30 cent dollars, why wouldn't you do that? Yeah. And so, but more recently, I think it's a lot around, a lot of the planning is around liquidity. And that can mean a lot of different things. It could be liquidity for estate tax. But for instance, if you're, in the example of the business, the family wants to keep it, at first death, there's not going to be an estate tax, right? Yeah. You're allowed to pass unlimited assets to your spouse. Mm-hmm. And so what you might need though is working capital to keep the business running, to hire somebody, a new CEO. If the breadwinner, mom or dad, was the CEO, to come in, you need liquidity for that. Another example is a lot of our private equity clients, right? They're constantly have capital calls going on. Well, they're paying for that typically either from a loan from a bank, working line of credit, or from cash flow. Yeah. If they die, there's no more cash flow. That's right. So protecting these asymmetric risks that people are walking around with is a lot of the planning that we do. It could be taxes, but a lot of times it's just what problems are these clients walking around with that having liquidity, if the unthinkable happened, would be
just
helpful.
Because you're worth a lot on paper doesn't mean you have 300 million in the bank.
100%.
Okay.
And I mean, a lot of people don't realize that. I mean, some of our commercial real estate clients have seen more than a 50% reduction in their net worth just because of the interest rate environment we're coming out of.
That's wild.
Yeah.
Do you remember what the Craigslist ad said to recruit you? Back 17 years ago.
Yeah. So I don't remember it exactly what it said, but essentially it was, in big letters, looking for people for financial industry.
Okay.
And so it was a very broad, but this firm that I don't even think exists anymore in Boston, they recruited specifically for the financial sector. And so, I studied math and I had no idea what I wanted to do. And this is more than I could have imagined.
Yeah. When a lot of people in our industry, they get into the business and then they just go right to recruiting. They're going to try to meet and get clients. And I think it really puts a bad taste in a lot of people's mouth. It's like, that's why there's almost a 90% turnover rate.
Sure.
You had, I think, a better experience. You started in the servicing space and then from there learned, didn't necessarily have to recruit and sell, and then from there continue to grow. You want to just break down a little bit of that story? Yeah.
When I came in, I was working in we called it the design department, but essentially analyzing product, building the presentations, taking a lot of direction from the people who were directly advising with clients and their advisors. After working for 4 or 5 years, I started running that department, and then shortly thereafter, the woman who was running our service team left, and I was like, hey, I think I can do that too. Yeah. And so I started overseeing both departments. And for me, the biggest thing I took away from service is when you're on a call with a client and their advisors, and you're not trying to sell something, but you're trying to speak to them, you're answering questions, you're reminding them of what the goal was. You're learning how to talk to them. You're learning how to answer their questions, how they consume information. So after doing that for a couple of years, I saw an opportunity to develop a process for converting existing clients into new clients.
There you go.
And so I've developed, we use Salesforce as our CRM. And I developed a line of reports that I could run each year that would identify from our book of business who the clients were that were going to be our best candidates for potential new opportunities, and built that into, at one point, about 50% of our annual revenues. And then after that, I started to directly advise.
That's amazing. That's amazing. All right. So I want to learn about premium finance, and this, I'll just give you like my big picture of like how I'd explain premium finance. So life insurance has a lot of benefits, especially if you're wealthy. There's benefits that from an estate tax purpose standpoint, trust, and when you pass away, you want leverage, cash flow coming in, or cash coming in to help you when you pass away. So instead of going out of pocket for all that money, because again, you could be net worth high, but maybe not the cash flow, you get to go to the bank and say, hey, this life insurance will help me. And it's a no-brainer. I have the money, but instead of going out of pocket and potentially selling other assets, what I'm going to do is I'm going to have you pay the life insurance, give me all the benefits, and then through that plan, potentially, it will pay back the interest and eventually pay back the bank. I'll have the death benefit and get the benefit from that. So that's like a very elementary, you can correct me where I go wrong, but that's about where it ends. If people come to us and they say, hey, we want to do premium finance, we work with people like you, because it's not something like you have to be very, very specialized in something like this. And I'm sure we could talk about nightmare stories of people that do premium finance because you're dealing with leverage. Where did I go wrong there? Talk to me about how you would explain that, and then let's go deep in some of the details.
So, I mean, at elementary level, that was a pretty good explanation. I think what a lot of people don't realize is, you earn money and it gets taxed, right? Yeah. And to your point, let's say that you invested that in whatever, your business, in a stock portfolio, and now it's time to buy life insurance and you want to own it in a trust. If you have to sell any of those assets and they have gains, you're going to get taxed again. Yeah. Now you got to get the money into the trust. Unless you have lifetime exemption or enough kids and grandkids to have crummy provisions that allow you to put a lot of dollars in, you're going to have to pay a gift tax.
Yep.
So now it's potential before the premium dollar ever gets paid, that dollar might have been taxed 3 times.
Wow.
One of the big benefits of premium finance is that when a bank loans to a trust, there's no gift. Mm-hmm. So you're skipping the gift tax that would be associated with getting that premium dollar into the trust. And so for our clients, first, most of them are used to using leverage in their life. They use leverage to build their business. They use leverage to because they're in the PE space and they use leverage regularly to buy and sell companies. So they're used to leverage and they understand the way that it works. And so, once the program is set up, you've got life insurance in a trust, you've got a bank willing to lend to that trust. That's when kind of the real work begins, because these are, we call them living, breathing programs, right? It's not as simple as here's my premium, I paid it, great, we're done. There's interest rate risks potentially on the loan side. You're investing those dollars or putting those dollars into a product that has either interest rate or market sensitivity. And so what you want to do, the real struggle and the real reason why I think more people either don't or can't is because the amount of servicing that you have to do is a high barrier to entry.
What's the minimum net worth you need to have to be before you even think about premium finance?
I mean, look, if you ask the carriers, I think it's between 10 and 20 million. I think a good rule of thumb is if the client can't afford the premiums on their own, you shouldn't even begin to talk about it. I mean, forget about whether they're liquid or not. If they could liquidate something and pay the premium, they can afford the premium, because the last thing you want to do is have a family end up losing not just the life insurance, but potentially
other assets.
Company, other assets, because you put them into a program that ultimately they couldn't afford.
There are people out there that do premium finance and they tie it to like income streams and it's a great retirement plan. What are your thoughts on that? Or do you think it should solely be set up for estate planning and it's a cherry on top if you use some of the other benefits, in quote unquote retirement?
Yeah, I mean, look, if it outperforms your expectations, then that's great. But I think the trouble becomes when you ask a policy to do too many things: provide a death benefit, grow cash value. I've even seen people show it repaying the loan and then also providing income. You're just setting yourself up to overpromise and underdeliver.
Understand. Yeah.
If you ask it to do too many things well, it's going to do most of those things just okay.
Yeah. All right. Talk to me with the steps on if someone's worth plenty of money, they want to do this. What are the steps that are involved in getting them from interested to becoming like actually setting this stuff up?
So we take them through a very in-depth education process, right? Yep. We want to make sure that they know that, hey, this isn't the only thing we do. This isn't the only option. But if this is a fit, here's the way that we would build it and the way that we would service it, so that they understand exactly what goes into it. So there's a long education process, including lots of downside testing, so that they can understand
worst case scenario.
Yeah. Where does it
interest
break?
Rates increasing, all this kind of stuff.
And so one of the things that we use as part of our program is whole life. And so you'll see a lot of these are built on IUL. And not that IUL is a bad product. I think that there's a couple of issues with it. One, it's hard to illustrate on an in-force basis. So even if you sell it at a responsible rate, because of the regulations, you may not be able to illustrate it at what it's earned or what it's projected to earn. The other issue is because of some of the new indices that have come out, you can illustrate it at very high rates. And that, as long as you're doing the due diligence of the sensitivity testing and the client's well educated, that's a preferential choice for the client. For us, the big reason why we like whole life is when you do a 100-year look back on dividend rates, first of all, they've never been below around 3%. And also they're highly correlated to interest rate markets. And so when you are borrowing short overnight rate plus a spread on these loans, and you're putting those premium dollars into a long asset that's going to participate on the long end of the curve and be correlated, you're mitigating some of the risk that you can have if rates spike and the market tanks.
That's right. Yeah. And it's one of those, if you want to potentially speculate, have increase. I mean, we host a lot of debates on just our multiple channels on IUL versus whole life, and it all really comes down to the IUL pitches over a long period of time. The idea, that the thought process is that they will get a greater return, but they will all admit that there's a cost to that. And especially if you're already crushing it in business and have other assets over here, and you're using leverage for an estate, like, there comes to a point where you're just like, am I okay? Like, would I rather have rock solid foundation or less rock solid foundation with potential upside? And in a lot of cases, people aren't putting money in insurance to begin with to have like the home run. And so I'm just like validating, like, I love the fact that you guys use whole life, and majority of people in the premium finance space that I've met are all IUL, mainly because of what I just shared. But then they also will say that you can get a bigger bang for your buck on the death benefit side, and there's more flexibility there. So I would love for you to unpack that.
Yeah.
But I appreciate that. I didn't know that there were many people out there that did premium finance whole life.
I don't think there's a lot of people that do it because it's viewed as an inflexible product, right? And so a lot of what we do in the education process is talk about what are your toggles, right? If something isn't going quite to plan, what can you do to mitigate, some of the inversions or short-term spikes that you might see along the way? And so we spend a lot of time talking about that. The point that you just made earlier about, the home run, right? We spend a lot of time, and I spend a lot of time educating clients and advisors on, I want to manage to a range of outcomes that is a foot wide instead of a mile wide.
Yeah, that's good.
And so, you might not, I say this to them, you might not hit the home run, but there's nothing wrong with a stand-up triple.
Yeah.
And so because anytime you are borrowing to acquire an asset, there's inherent risk. Yeah. If we can mitigate those in, these clients who have all this volatility and all this variability, market rate risk in the rest of their life, we don't want to add more of that. We want to diversify away from that. And so using something that's tied to, more like 10-year treasuries plus a spread, whole life, that's also going to travel with interest rates, you're taking a lot of that risk out of it.
I love it.
Still not no risk, but that's where the service and the management comes in to help mitigate the other risks.
Before we transfer over to private placement life insurance, which I'm pumped to learn about that, what are some of the horror stories that you've seen in the space in the 17 years you've been servicing and working with people? I'm sure you've seen some disaster stories when it comes to premium finance.
A lot of it comes around the reporting. These clients. So one of the things that we do is, if you sit down and we decide we're going to move forward with a premium finance plan, you got to know that you're seeing me every year, and you're seeing me before the premium's paid. And so it's a lot of work, but it's the right way to do it, because if we're talking about potentially 7 or even 8-figure premiums that are being borrowed from a bank, you want to know before we pull down a couple $1 million loan, hey, was that the right thing to do? Where did we think we were going to be, and where are we now? And so we have a process that we go through with them. And I'll give you a for instance, and then I'll answer your question. Last year, and actually over the last 2 years, we obviously have been living in an inverted yield curve, high interest rates, and we have about 70 premium finance cases on the books. None of them went off the books.
Wow!
Because we serviced them, and because we came with ideas. So for some of our clients, they looked at the rates, and what we said was, look, there's a lot of options. You can pay a little bit more loan interest to offset that. You could use estate dollars, do an AFR loan, disintermediate the bank for a year, and then when rates normalize, borrow it back and pay back the estate loan. And so when you come and you have ideas and solutions, even if it's not great news, we thought we were going to be here, we're a little off. The clients are comforted because you did exactly what you said you were going to do. We're going to show up. We're going to talk about it. We're going to talk about your options. Most of them just posted a little bit more collateral, pulled down the loan, and went on. But knowing that knowing that we did what we said we were going to do, we're reminding them that there are these options, gave them a lot of comfort. What I have seen go horribly wrong is no downside testing, lack of reporting, potentially very truncated projections. One of the biggest offenses I saw was a client of mine now was sold some premium finance, and throughout the whole process was never shown a projection past year 5, because that's when the high early cash value rider fell off. So when we finally got,
is that like malpractice all the way around, or
it's just not the right way to do it.
Yeah, I agree.
And so when we finally got the illustrations and we showed the client the range of outcomes depending on what we were assumed, it was also an IUL, they were disturbed. And it wasn't even that the plan blew up in year 15 or didn't last to life expectancy. It was the fact that they had no visibility.
Yeah.
And when they got the visibility, they didn't like what they saw.
Yeah.
And so, you'll see that now and again. I would say for the most part, even the people who are using IUL, there are they're well-known people in the space, and they do a good job.
Yeah.
I'm not going to say everybody who uses IUL isn't doing it right. Simply not true.
Yeah, I get it.
But you definitely,
there's more levers.
There's a lot more levers. There's more variables, and there's more ways to make, especially when you're doing the initial modeling, the illustrations look maybe better than what might be the actual outcome.
I love it. Private placement life insurance. This has been in the news. This is kind of like, when I think of private placement life insurance, correct me if I'm wrong, but it's investing in investments with a life insurance wrapper. So you kind of get the benefit of investing in what you want to invest in, with also the tax benefits that life insurance gives you. Tell me where I went wrong there, and then talk to me about how people can take advantage of PPLI.
Yeah, so great question. Has gotten a lot of notoriety over the past couple of years. What's interesting about that, and I'm a member of FinSecca, and we were on the Hill last year, and we talked a lot about this with lawmakers. And so, life insurance has been tax-free for over 100 years.
Yeah.
And tax-free on the inside buildup.
Yep.
And death benefits that pay out tax-free.
Yep.
And that's important, right? There's a lot of social good that comes from people owning life insurance.
Yeah.
And so that's part of what FinSecca does, is we try to protect that.
Mm-hmm.
And private placement, I think, is often misunderstood. It's basically just a variable universal life product, right? Which anybody can buy. Yeah. Where people get hung up is that the regulators limited who could buy it. Yeah. That was not the insurance carriers. That was not the insurance agents. That was the regulators. And so now some of them are upset because they will say, hey, this only is applicable to 1% of the population.
Yep.
Or whatever.
It's not a great look.
It's not a great look.
Yeah.
And what we've argued is that, but we didn't do that.
Yeah.
That was not something, those weren't guardrails we put in place.
Why did the regulators step in?
Because the type of investments, like if you think about a traditional variable universal life, it's got mutual funds in it.
Yeah.
Right. When you think about PPLI, the investments are more complex.
Yeah.
So you have to qualify under 2 things: qualified purchaser and accredited investor. Yeah. Accredited investors,
pretty easy.
Isn't hard. I mean, if you have your Series 7, forget about how much money you're worth. Yeah. You're an accredited investor. Yeah. They're trying to expand that to other licenses, but also if you make, I don't think this has changed, but as a single person, $200,000 a year, as a married couple, $300,000 a year, with the likelihood that will continue. You're an accredited investor. Qualified purchaser is a little bit harder. You have to have $5 million of investable assets.
Yeah, I would say that's a lot harder.
That's a lot harder.
To qualify.
A little harder, a lot harder. Yeah. It's very difficult. That's the one that really disqualifies most of the population. Yeah. If you look at the PPLI market on its own as a percent of the overall life insurance market, it's about the same percentage as the people that some people might be familiar with the bill or the proposal that was put together by Senator Wyden. He talks about 0.001% of the population having access to this.
Yeah.
I would argue that I don't think it's quite that low, but if you look at the amount of death benefit in PPLI or even cash value as a percent of the whole industry, it's about 0.001 or 0.01%. So it's made out to be a lot bigger of a piece of the life insurance industry than it actually is.
Yeah.
That doesn't mean that his arguments are flawed. It just means that it's not as widely accessed as I think people think it is.
Yeah. How does it work? Because is the only difference the type of investment is more maybe more liberal than maybe what you could get through like mutual funds?
Yeah. So it's not even that it's more liberal. I mean, a lot of it is just, it's very tax inefficient investments if you own them outside of life insurance. So like, a lot of people invest in credit funds, right? Yeah. If you live in a high tax state and your tax brackets in the 40 to 50%, it's very hard to get a lot of return out of these credit funds.
Yep.
And so one of the things you can do is you can have that be your strategy inside of a PPLI policy. And so it's, VUL is, which anybody can buy, the mutual funds, it operates exactly the same. The investments are just geared to be more tax inefficient. And I think what happens is those investments tend to be higher earning. Yeah. So it exacerbates the problem of people feeling like, well, it's only for the wealthy and they get access to a return that's going to be higher than what I can get in my VUL. Yeah. The issue is they have a lot more volatility. Yeah. And there's, you could just as easily have a down 20 year as an up 20 year.
Is it possible with PPLI to have higher early cash value, or can you structure a variable universal life policy the same way?
Yeah. So, with PPLI, this charge structure is very different. So you actually do get pretty high cash value right out of the gate because the charges are super thin. Yeah. If you think about a traditional life insurance policy, the broker that if they're selling let's just say a level funded, same annual premium forever.
Yep.
This is an oversimplification, but they get paid about 90% of that first year premium on average, call it plus or minus. Yeah. It's a little more complex than that, but just for argument's sake, with PPLI, they can charge whatever they want. Yeah, interesting. And so if you have somebody putting in, let's just say $1 million, and you want to say, I'm going to take a 5% setup fee, which by the way, I don't think anybody does, but they could. That's a lot of money. Yeah. What I'd say is more common, like for us, for financial architects, we don't ever take a setup fee. Yeah. We take a basis point trail to manage the policy over a long period of time. And that's it.
And I've heard some people say like 50 million is kind of like the minimum. How would you answer that? Like to really consider PPLI
from a net worth standpoint?
Yeah, just from a net worth standpoint, and just like when does it make sense to do that over just traditional overfunded whole life or IUL?
Yeah. I mean, I think the biggest driver of that is jurisdiction. Right? Somebody who's living in California, who's living in New York or New York City, they've got an income tax problem. They probably have an estate tax problem. Yeah. And so we see this with a lot of our clients as kind of an add-on. Like let's tackle the bigger problem, and then we can work on some of the other tax inefficiencies that they might be walking around with. Some people will say PPLI can do both, and they're not wrong. Yeah. But it's like, how much risk do you want to take on to make sure that your family has the liquidity that they need when you pass to pay estate taxes, hand down the family business? Yeah. So from a net worth standpoint, I mean, it depends. If someone's really interested in investing in something that's tax inefficient and they're worth $10 million and they want to throw, 500 or $1 million, 500,000 or $1 million into it, maybe it's a fit. I mean, you got to look at.
And it's not one of those things you have to pay ongoing. Like it could just be a lump sum.
Can be a one time. Yeah, okay. Sure. And so, carriers are going to have some minimums, but they're not, it's not like $1 million a year. Yeah. It's still a lot of money, but I don't think that certainly people who are worth less than 50 million could still be a good fit for this, depending on what they're trying to accomplish and what their investment thesis is.
Awesome. Man, there's anything else you want to say about private placement? Like it really comes down to if someone wants to invest in something that potentially is tax inefficient, they can make that. You can put a wrapper on insurance. You're saying that when done properly, the fees can be pretty reasonable when it comes to that.
It's very transparent. And I think that's something that clients really like.
What's the end goal? Are people trying to get income out of their PPLI, or how do people spend that money? Like, what's the goal for?
Could be. I mean, it could be.
Or just pass it on.
A lot of them, I think they look at that as like, that's my last bucket.
Yeah, because the PPLI doesn't give you a crazy high death benefit does it?
It depends. If your return's good, the death benefit's going to grow. But you're right. You're not buying a lot of death benefit. When you put the premiums in, you're trying to.
So is the goal to get income? Like, then how do you get the money out?
Yeah.
Tax advantage, I guess.
So when it's life insurance and structured properly, you get FIFO treatment. Okay. So you get your basis out first, always. Okay. And then you can take policy loans.
Okay. Similar to just a traditional whole life or IUL.
It's exactly a VUL product. Okay. Variable universal life. It just has different investments.
Okay. What are the potential downfalls of where have PPLIs gone south?
Yeah, that's a good question. I mean, a lot of them that were put in place in pre 2015, the investment choices weren't fantastic. There's some good ones, and there's some that have a very long runway of being very successful. But there was a lot of them that were a lot of insurance dedicated funds or IDFs that were built for like one client. Yeah. And they didn't get a lot of subscriptions, and I don't know how well managed they were. And so for a lot of private placement's not new. It's been around for a long time. The investments haven't been great. Yeah. The choices haven't been great. So I think some of them have underperformed. I don't know that any of them have blown up, especially if you think about the way they're funded. A lot of money up front for as little death benefit as possible to grow the cash. You want to minimize that insurance charge. And so even if you thought you were going to get 8 and you only got 4, the policy is probably still in place because the fees are so low. Yeah. And so I think with any good life insurance portfolio, regardless of the product, the success is directly tied to how well it's serviced. Yeah. So if it was sold properly, illustrated properly, and the advisor is showing up to service,
comes down to service. Yeah, comes down to communication and service.
That's it. Set expectations. Reset them when you have to. Don't be afraid of the data. Look the client in the eye. Tell them what's going on. Give them their options. Yeah. Even if it's bad news, they're going to appreciate it.
Yeah. There's things called bank-owned life insurance, POLI. There's company-owned life insurance, COLI. I know that you have a partner-owned life insurance. I know that that's not something we can go deep in. Maybe that's part 2. But how would you? What problem are you solving as it relates to that?
No, it's a great question. So, partner-owned life insurance is a really interesting space. Again, not one that's new, but one that we have made a lot of strides to get into because we have a retirement savings problem in this country. From the bottom all the way to the top, from your high earners to your everyday people walking around. Yeah. And so qualified plans only go so far. And where they stop is where some of those OLIs that you mentioned, COLI, POLI, and now POLI can help fill some of those gaps. And so without going too far into it, when you have large partner groups with high earners that can't save enough, there could be an interesting opportunity to create a vehicle for them to have added savings. And, if you think about successful lawyers, right? And they're maybe they're not worth 50 million, but they're making 1 to 2 million a year. Yeah. About the most they could put away if they max out 401k and cash balance is somewhere around $5 million. Yeah. If you crescendo your earnings right before you retire and you're making a couple $1 million a year, $5 million is not going to last very long if you want to continue living the way that you were living at that point and retire at 65 or 70. Yeah. And so this is a creative way of addressing the retirement saving issue. And it works really well for large partnerships. Yeah.
Yeah. I love it. Is there anything else that's on your mind that you want to share? I mean, this has been great. And I feel like I better understand premium finance, PPLI. We'll learn more about POLI and just how how people use that. But is there anything else you want to share?
Yeah, I would just say that life insurance as an industry, I think, is a lot more collaborative than people expect it to be. People think we're walking around and we're all competitors, and it's a great community, especially here at Partners Financial. I'm a member. I've been a member since day one of my career, and now that I'm doing the direct advising, having access to people who, quite frankly, have been doing this for twice as long that I have, and being able to pick their brains and get input from them has been something that has really helped me. And it's just, I think when you look at highly competitive industries, you don't get as much collaboration as we do in this one. And I think that that's really cool.
Yeah. How would you, before we land the plane, what would be your pitch on why life insurance? Like, out of all the things that you could be doing, why, what do you see, and how do you view life insurance as an asset that's beneficial?
Yeah. I mean, look, a lot of it comes down to what risks are you walking around with every day where if you weren't here, it's going to make someone else's life harder, especially wife, kids, other loved ones that maybe you have a responsibility to. It could be, Tony Green, who is a member of Partners, and he is involved in a lot of those OLIs you mentioned. He said something speaking at our study group that I thought was really cool when he goes in and talks to businesses is close your eyes and imagine your top 20 employees. Now pick one of them and imagine they weren't here tomorrow. Does that ruin your day, your week, your month, or your year?
He said that.
If so, I just think that it can be such a valuable tool. Yeah. And, liquidity is something that's so important because you need it the most when something's gone wrong.
That's good. Thank you for being on the show. Thank you for what you do. And I'll just say, if you're watching this, if you're listening to this and you're like, I want to learn more about some of these things, I potentially even want to work with your firm, we'll have a special link for you down below for you to learn more and connect you with the right people. Dave, thank you. And I look forward to getting to know you better, and appreciate the masterclass and some of these life insurance strategies.
Thanks very much, Caleb.
Yeah.